Welcome to the deep dive. If you're joining us today, you are diving into a truly fascinating setup.
Yeah, it's an incredible situation to look at.
Today is March 3, 2026, and we're setting out on a very specific mission based on the stack of research and market data we've got in front of us.
Right.
We're going to unpack the strategy and the intense recent market momentum of an independent upstream energy company called EON Resources.
They operate, right in the heart of the Permian Basin.
Exactly. And the context for today's exploration is frankly critical for anyone tracking the broader market.
I mean, absolutely.
Because right now, as we speak, EON Resources is lighting up the boards.
They really are. They're currently one of the most active stocks out there.
We're printing notable price gaps right in the middle of a massive global energy sector rotation.
And we're looking at what can only be described as a masterclass in corporate strategy.
Yeah.
The underlying theme for you to keep in mind today is how a smaller, highly focused niche energy player actually goes about building a formidable competitive moat.
A moat against the monolithic giants of the Permian.
Exactly. What's fascinating here is the specific alchemy of their approach.
They're combining a disciplined, arguably old-school secondary extraction technique.
Right, with incredibly well-timed, modern financial defense strategies.
It's a highly deliberate playbook.
Designed to insulate them from the exact volatility that typically just crushes smaller upstream producers.
Okay, so let's unpack this, because this is the central dynamic we want to decode for you today.
Yeah, how does a company with roughly 19,000 acres quietly position itself to win?
Which, by the way, in the grand scheme of the Texas oil business, 19,000 acres is a relatively focused patch of dirt.
Oh, absolutely. So how do they win in a highly volatile, entirely unpredictable global oil market?
To answer that, we have to look at the foundation they've built over the last few years.
Specifically, their land acquisition strategy in the Permian.
Right, because the Permian Basin is arguably the most scrutinized oil-producing region on the planet.
It is. Building a footprint there requires immense capital discipline. EON didn't just aggressively bid on unproven acreage.
No, they constructed their current portfolio through two highly calculated mature acquisitions.
The anchor of this strategy was acquired in November of 2023.
This is the Grayburg-Jackson field.
We're talking about roughly 13,700 acres, and the key data point from the filings is the existing infrastructure on that land.
Right, it came with 342 actively producing wells.
Alongside 207 water injection wells.
When you look at the sheer density of that acreage, 342 producing wells and 207 injection wells right out of the gate, you realize this wasn't a speculative play.
Not at all. They bought an established, actively churning industrial operation.
And then they doubled down.
Fast forward to June of 2025.
They execute their next move by acquiring the South Justice field.
This addition bolted on another 5,360 acres.
And 130 producing wells to their portfolio.
You put those two together, and you have a highly concentrated, incredibly active footprint operating under a single corporate umbrella.
And the structural advantage of that umbrella cannot be overstated, right?
A critical detail in the term sheets for both the Grayburg-Jackson and South Justice acquisitions is that EON secured a 100% working interest in these core assets.
100%.
Yes, by completely avoiding the usual joint venture dilution and the, endless partner negotiations that plague capital deployment in this sector.
They have total operational control.
Total control. They dictate the pace of their secondary recovery timelines.
They control the capital expenditure.
And they capture the entirety of the upside.
Which, in an industry defined by intense capital requirements, having unilateral control over your asset base is a massive structural moat.
It gives their management team the agility to pivot without calling a committee vote.
So let's zoom in on the actual mechanics of how EON extracts resources from these mature fields.
Because this is where the narrative shifts from a savvy real estate roll-up into a pure engineering play.
Right. EON relies heavily on water flooding.
Or secondary recovery.
We're looking at a fundamentally different operational cadence compared to the primary shale extraction that dominates the Permian headlines.
This is the operational engine driving their margins.
While larger Permian players like, say, Occidental or ConocoPhillips,
who are largely focused on primary extraction from shale.
Right. They're battling notoriously steep decline curves.
Exactly. A typical shale well produces a massive flush of oil in its first year,
But then production can just fall off a cliff shortly after.
forcing those giants onto a highly capital-intensive treadmill.
They have to constantly drill new wells just to maintain flat production levels.
They're essentially running at a sprint just to stand still.
But EON steps off that treadmill entirely.
By utilizing those 200-plus injection wells to flood the underground reservoirs, they actively maintain the subterranean pressure.
Systematically forcing the incremental oil toward their producing wells.
And the decline curve on a well-managed waterflood asset is remarkably flat and predictable compared to primary shale.
So if we connect this to the bigger picture,
You see why Dante Caravaggio and the executive team at EON prioritize these specific assets.
they're targeting mature, undervalued fields that the broader market might consider largely depleted.
Exactly. By applying disciplined secondary recovery science, they achieve highly cost-efficient recovery over a drastically extended timeline.
It requires a different kind of operational patience.
But it yields a baseline of stable production that doesn't require a relentless multi-billion-dollar drilling budget just to keep the lights on.
So what does this all mean for the current moment?
We have to pivot to the March 2026 macro environment.
Right, and examine why the market is aggressively bidding up EON's shares right now.
As we noted at the top, they're appearing consistently as top pre-market gainers.
Charting significant price gaps. We're seeing intense overnight buying pressure and massive volume flowing into the stock.
Signaling that institutional money is recognizing the value of this specific operational model under current conditions.
And that volume is being driven by a severe macroeconomic catalyst,
Energy shares are rising broadly across the sector.
stemming directly from escalating supply disruption fears in the Middle East.
Right. The market is reacting in real time to the recent U.S.-Israel strikes on Iran,
And the cascading concerns over the security of the Strait of Hormuz.
which remains a highly vulnerable choke point for global crude transit.
Now, we need to be very clear here for you listening. We are looking at this strictly objectively.
Absolutely. We aren't endorsing any political viewpoints or taking a stance on the conflict itself.
We are simply analyzing the raw cause and effect on commodity prices exactly as it's reflected in the market data.
Because it's a stark reminder that energy markets are intensely reactive to geopolitical shockwaves.
The recent strikes and the tensions surrounding the Strait of Hormuz are currently acting as a massive risk premium on the commodity.
Driving capital into safe haven domestic producers like EON, regardless of the broader political landscape.
The objective reality reflected in the pricing data is that when global supply chains are threatened, the underlying commodity spikes.
And the market ruthlessly reprices companies that have secure domestic production.
The market is fundamentally a pricing mechanism for future risk.
And right now, it is heavily pricing in geopolitical instability.
That risk premium acts as a tremendous tailwind for independent domestic producers.
Think about a company like EON, sitting in Texas, running a predictable waterflood operation.
They suddenly see the margin on every barrel they pull out of the ground expand dramatically due to events occurring half a world away.
It is the ultimate right place, right time scenario for an upstream producer.
But looking at this objectively, we have to acknowledge the macro vulnerability here.
Let's hear it.
Let me play devil's advocate for a second.
Sure.
If you've traded energy for any length of time, you are intimately familiar with the boom and bust cycle.
Oh, yeah.
If this geopolitical shock pushes oil prices too high, the historical precedent is that it eventually triggers a broader economic recession.
Which in turn causes massive demand destruction.
Exactly. And if industrial and consumer demand collapses, the price of crude crashes right back down.
It plummets.
Relying purely on geopolitical spikes is a notoriously dangerous game for an independent producer.
That boom and bust cycle is the existential threat to the energy sector.
Right.
And it's precisely why EON's recent financial maneuvers are so critical to their thesis. They didn't simply sit back to passively ride the wave of high prices.
They played defense. On February 12, 2026, EON announced a highly aggressive hedging position.
A position that fundamentally alters their risk profile for the next 18 months.
Let's break down the architecture of this hedge, because the specific ratios they chose are revealing.
According to the filings, EON locked in 60% of their 2026 oil production.
This hedge covers roughly 20,000 leasehold acres and 750 wells across their portfolio.
Furthermore, they extended that protection by locking in 50% of their production for the first quarter of 2027.
The decision to hedge exactly 60% is a highly calibrated move.
It really is. By locking in a premium price for the majority of their output, they effectively guarantee a revenue floor.
A floor that covers their base operating expenses, debt servicing, and planned capital expenditures for the entire year.
Regardless of what the spot market does tomorrow.
If the demand destruction scenario plays out and crude prices plummet, EON is financially insulated.
But the remaining 40% is where it gets really interesting.
Because by leaving a significant chunk of their production unhedged, they retain the ability to capture the immediate upside of this geopolitical risk premium.
Right. If the conflict escalates further and crude continues to break out to new highs, that unhedged 40% acts as pure margin expansion.
They've built a concrete safety net underneath their cash flows while keeping the ceiling open.
It creates incredible stability for their free cash flow generation.
In a sector where highly leveraged producers frequently face bankruptcy during sudden commodity downturns,
This specific blend of predictable secondary recovery paired with a 60-40 hedging structure is what separates the resilient operators from the casualties.
they've effectively de-risked their 2026 operational budget.
So we have the foundation of the 19,000 acres,
The 100% working interest.
the low-decline water flooding mode,
The massive geopolitical tailwind.
and the financial armor of the February hedge.
Looking ahead over the next 3 months, what are the specific catalysts you should be tracking?
First and foremost, the market is bracing for the upcoming post-Q4 2025 10K filing.
Which will directly set the stage for the Q1 2026 earnings release.
The 10K is going to be heavily scrutinized by analysts, primarily to judge the operational integration of the South Justice Field.
Remember, they acquired that asset back in June of 2025.
And the upcoming filings will finally provide hard, transparent data on how efficiently EON has integrated those 130 producing wells into their broader waterflood infrastructure.
Analysts will be zeroing in on the lease operating expenses.
Looking for proof that EON's management team has successfully optimized the South Justice acreage under their 100% control model.
Beyond the standard earnings and SEC reporting calendar, there are 2 distinct, highly bullish indicators buried in the recent data that warrant serious attention.
If you track the Schedule 13DA filings from late 2025, there is a very clear pattern of cluster buying.
And notable ownership shifts occurring among insiders and major institutions.
Institutional cluster buying in a mature secondary recovery asset is a massive signal of confidence.
When you see multiple insiders and institutional entities actively accumulating shares rather than just holding existing positions,
It suggests a shared consensus that the broader market is currently undervaluing these Permian assets.
it indicates that the smart money anticipates strong execution on the South Justice integration.
And robust cash flow generation in the coming quarters.
They are positioning themselves ahead of the fundamental data.
And that brings us to the final and perhaps most speculative catalyst in the EON thesis.
We've spent this entire deep dive analyzing their highly predictable, low-decline waterflood cash flow.
But the lingering question is what a management team does with a mountain of stable free cash flow once their downside is fully protected by a 60% hedge.
The source material points to EON potentially reinvesting that capital to evaluate horizontal drilling across these mature fields.
Which raises an important question about the technological evolution of mature basins.
Water flooding is highly effective for sweeping remaining conventional reserves.
But horizontal drilling is the precise technology that ignited the modern shale revolution.
The engineering challenge and the massive potential reward lies in applying modern lateral drilling techniques to rock formations that have already undergone extensive secondary recovery.
It's an ambitious pivot.
They have spent years optimizing the vertical extraction through water pressure.
But if EON can successfully push a drill bit sideways through the Grayburg-Jackson or South Justice fields,
They could essentially bypass the swept zones and tap into entirely new, previously isolated pockets of the reservoir.
if the horizontal evaluation proves commercially viable, it completely rewrites EON's reserve replacement ratio.
It would unlock massive, previously inaccessible reserves within their existing footprint.
Fundamentally changing the valuation of their 19,000 acres.
It is a calculated high upside swing.
But crucially, it's being funded by the heavily protected, safe money generated by their hedged waterflood operations.
Synthesizing all of this data into a cohesive view, the fundamental setup we are looking at scores a solid 7 out of 10 for bullishness based on the current market metrics.
For anyone tracking the energy sector, EON presents as a highly compelling swing trade candidate heading into the Q2 2026 catalysts.
You're getting leveraged immediate exposure to this massive global energy rotation and the geopolitical risk premium.
But your downside is heavily mitigated by their 100% working interest.
The flat decline curves of their waterflood assets.
And that aggressive 60% revenue hedge.
The structural discipline on display here is exactly what institutional investors look for during periods of intense macro volatility.
They've engineered a highly resilient balance sheet capable of absorbing a sudden demand shock,
while retaining enough unhedged torque to significantly outperform if the supply constraints in the Middle East persist.
So to pull all these threads together for you today,
we started by looking at a relatively small 19,000-acre footprint in the Texas dirt.
And we've seen exactly how, through rigorous capital allocation, the steady, unspectacular science of water injection and precise financial hedging,
an independent company can perfectly insulate itself against the chaotic volatility of global geopolitics.
They have built a self-sustaining fortress right in the middle of the Permian Basin.
And the architecture of that fortress leaves me with a final, provocative thought for you to consider as you watch the energy markets evolve.
Let's hear it.
The reality of global geology is that the quote-unquote easy oil is largely gone.
Primary extraction from Tier 1 shale acreage is going to yield less and less over the coming decades as the best drilling locations are exhausted.
Exactly. As decline curves accelerate across the industry, we have to ask a broader question.
Will disciplined secondary recovery techniques, like EON's water flooding model, eventually transition from being a niche competitive advantage for smaller players
into the absolute mandatory standard for survival for every major company operating in the global energy sector?
That is a brilliant framework to end on.
It forces a complete reassessment of how we value mature assets.
And what the future baseline of energy extraction actually requires. Thank you for joining the conversation today.
We hope this deep dive provided you with a sharper, more nuanced lens through which to analyze the current energy rotation.
Keep questioning the surface-level price action.
Keep digging into the underlying structural strategies, and we'll catch you next time.